All right. So, hi everyone. We're going to get started. We are still waiting on some people to filter in, but again, we're just going to hop right into it. So, I'm Alana. I'm the Operations and Events Manager at the Innovation Cluster. So, for those of you who do not know, the Innovation Cluster is a not-for-profit organization, and we work with startups specifically working in technology. All of our events, such as this one, are open to the public. And we are also part of the Team PTBO group, which includes some of the organizations that you're seeing on your screen right now. And also featured on your screen are some of our partners. So again, thank you for joining us for this virtual hands-on, the importance of crash testing your business on paper. So today, the workshop's going to be facilitated by Adam McEnroy, an associate consultant at IG Wealth Management. IG Wealth Management is one of our knowledge partners. So today he's going to discuss the importance of playing through several what-if scenarios, steps that can take to reduce the risk of your business in these scenarios, and why it is critical that you have a shareholder agreement and it is shared and reviewed with your financial planner. So for those of you that have questions at the end of the presentation, I will enable the chat feature on your Zoom, and you can type your questions in then. This is also going to be recorded, so if you do have any questions or want to refer to the presentation, you will be able to. I will send a link with the YouTube link to the presentation, as well as a survey that is going to be sent out around 1 or 1:30, so you can let us know what you liked, what you didn't like, and what we can do to improve, or even what you would like us to see in regards to content. So I am going to pass it over to Adam now to get started.
Good afternoon. You should be able to see my screen there, right, Alana?
Yeah.
Awesome. Perfect. So I want to thank everyone for tuning in this afternoon to this event, and the Innovation Cluster for hosting it. You know, we're going to spend the next 40 to 45 minutes together talking about crash testing your business. And the topic has come to my mind as we emerge from the COVID-19 storm. I'm going to use the analogy of the COVID-19 storm throughout this presentation, because although we're all going through it together, we're certainly all having different experiences as business owners as we go through this storm. You know, some of us are in a canoe and we're paddling with a life jacket and a bailer, and we're trying everything that we can to not go underwater. For others, we're in a battleship and we're going through this storm, and there's gale force winds and there's huge wakes. But we know that if we continue to plot forward, we're going to get through it. So I don't want to make light of it. We're all going through a storm. We're just having different experiences as we go through that storm. So why this topic and right now? Well, for many of us, we never thought it was possible, let alone plausible, that our businesses would be forced to close because of the threat of an illness. And regardless of what type of business you're in, we've all had to adapt to different situations and increase our reliance on technology, developing and implementing new streams to generate new revenues, and strategies to manage our teams in different methods. My concern, and where I am coming from this aspect of the business planning is, are we doing our due diligence and looking backwards to say, what have we learned from our experiences going through COVID-19? And is there ways that we can improve not just the business and the revenue generating components of it, but have we looked at other what-if scenarios that are possible? A little bit of background about myself before we get too far into it. I'm a University of Waterloo graduate from the University of Waterloo in a Bachelor of Science Kinesiology co-op degree. Upon graduation, I found full-time work with a large employer in downtown Toronto in the health and safety department. After about 16 to 18 months working for them, I sought new employment for a large international company right here in Peterborough. I worked in their health and safety department. My son was born in 2013, which, while I was employed there, really caused me to take a step back and evaluate what quality did I want out of my career. And I saw where my career was going in the next 20, 30 years. And although there was nothing wrong with it, it was definitely a very lucrative career. I realized that I needed to make some changes. So I did a lot of research, a lot of discussion, and a ton of education, and decided to partner with IG Wealth Management in 2014. I earned my CFP designation, Certified Financial Planner designation, in 2017, and my Chartered Life Underwriter designation in 2018. I chose to partner with IG Wealth Management because we've been inspiring financial confidence in Canadians for over 90 years. We manage over $80 billion in assets and on an annual basis give $70 million to community organizations, including the Alzheimer's Society. We are one of the largest wealth managers in all of Canada and ranked in the top 10 internationally. But we recognize that no one company has a monopoly on investment ideas. And so we've partnered with other companies like BlackRock, PIMCO, T. Rowe Price to ensure our clients are getting not just our own internal expertise, but also that of external providers. We have insurance partners from Canada Life, Great-West Life, Manulife, and RBC Insurance and Sun Life Insurance to ensure that not only can we competitively quote for clients, but we're understanding the nuances of different policies. And when we put an insurance policy into place for clients, it's truly the best in class solution for them. Our focus when we work with clients is on delivering comprehensive solutions, all the way from managing cash flow more efficiently, both on the corporate and on the business side of things, to planning your estate, the business succession, transferring of wealth down to multiple generations. I work as part of a team. I'm partnered with Janice McEnroy, my mother. Between the two of us, we have over 30 years of financial planning experience, and we have our admin staff, Shakina and Pamela. We also have a team of local specialists. Steve McInnes, our insurance planning specialist, is involved in more complex insurance scenarios, such as wealth transfer down multiple generations, could be buy-sell agreements or shareholder agreement discussions. Michael Graves is our securities specialist. He's dealing exclusively with high net worth individuals. And Edwin Oswego is our mortgage special and lending specialist, dealing with residential lending needs. Behind them is our advanced financial planning team with some of the most sought after talent across Canada. We have Christine Van Kallenberg and Jack Courtney heading up this department that consists of over 30 professionals ranging from lawyers to accountants to actuarials, depending on what the specific question is that we're dealing with for clients. They all have their area of expertise. That's just a little bit of background about who we are and why I chose to partner with IG Wealth Management when forming my practice. But let's jump right into it. Alana did a great job for outlining the agenda for today. I really want to walk through some what-if questions and the impact they may have on your business, understanding why it's critical that you have a shareholders agreement and it's reviewed with a certified financial planner, and then finally, steps that you can take to reduce the risk to your business. COVID-19 has provided, in my opinion, some really valuable teaching lessons. Regardless of what kind of storm or what kind of vessel we're riding through the storm in, whether it's a canoe or a battleship, I think we can all agree that to some extent we've had an external stress created in our lives. For some of us, myself included, I was driving down the 401 to see some clients as Doug Ford got on the radio to do his announcement of the state of emergency. It didn't create so much a panic in my mind at that time, but certainly thoughts started going through my mind of how is this going to impact my business? How is this going to impact my clients? And like it or not, I had a sense of loss of control. I was all of a sudden mandated not to be seeing clients in person. Like several of us at this event, I've had to pivot to meet virtually and connect with clients in different manners. But it's that sense of loss of control of the unexpected and that stress that has also caused our emotions to rise. We're potentially, fearful of how we're going to run a business. And so the emotions are have increased that much higher. Or for some of us, it may be, we've had to close up shop for a month or two, and we've seen a loss of revenue, and we're not even sure if we're going to be able to reopen the doors. We're literally in that canoe bailing as the water's coming over, and it's coming over just as quickly as we're able to bail it. Regardless of how we're riding through this storm, we all have had an unexpected twist in how our business operation was going to run this year. It's something that we had not planned for. I don't think any of us could have ever predicted that the government would come in with one foul swoop and say, we need to stop business operations. We're closing up doors. We're not able to meet with clients in person. And as a result, our emotions are that much have been raised. It's really important that we identify that there's two different types of risk. COVID-19 has brought on what I consider to be a systematic risk, which is the probability of a loss associated with an entire market segment. It's caused a major disruption across the majority of industries, but as such, the government has stepped in and designed programs to help manage or try to help businesses survive. And we're not here to debate the merits of those programs. We can certainly have that discussion offline, but really my focus here is that a systematic risk such as COVID-19, there's been government programs through COVID-19 and historically that have propped up businesses or tried to support businesses and Canadians. What I want to focus on today, though, is the unsystematic risk, the probability of a loss within a specific security or within a specific business. The what happens if to your individual business, not to the entire range of labs out there or manufacturing facilities, but what happens specifically to your business. So my question that I'm going to be asking throughout this presentation is, what would happen to your business if you were exposed to an unsystematic risk? The focus that we hear about mostly when we talk about unsystematic risk is, well, we're looking at maybe a business flooding, the theft of IT, proprietary information, a fire in the business, manufacturing going down. What I'm going to look at is the human side. What happens if someone became ill, disabled, died prematurely, or there was a disagreement between shareholders. And COVID-19 not only has it created this unprecedented shutdown, but it's also made us face the reality that there's people out there who unfortunately get sick, and it has an impact on businesses. So the question that we're going to run through today is, who's running your business? And in my mind, there's really three key categories of people that are critical to the success of your business. For some businesses, if you are a single owner, sole proprietor, all three of these people may be one person. For other people or for other businesses where there's multiple shareholders, there's multiple generations involved, these may be all different people or different tiers of the organization. The big thing to recognize is they all have a critical part to play in the success of the business. A key person, if I'm looking at a lab, for instance, if we're in a lab doing sampling, a key person may be the only one qualified, trained, and have the educational expertise to be carrying out that very unique testing. When I was at a large manufacturer in the health and safety department, they were doing weld tests, and there was only certain people that were capable of performing that weld test. If that person was sick, that weld test couldn't happen to meet the customer's spec. And so if that person was disabled for an extended period of time, if they're out of work, if they happen to prematurely pass away, not only could that testing not happen, they'd also have the cost of retraining someone to be able to do that testing to the customer's specs. So that's an example of a key person. Another example of a key person might be someone who's responsible for generating 90% of the revenue for the business. They might be a key salesperson who's huge. If they were off work for an extended period of time, that could have a major disruption to the cash flow and the revenue for the business. Owners is another one. And we often think of owners as the person who's opening the doors, closing the doors at the end of the night, having key relationships with suppliers and distributors, managing staff. And it's certainly that the staff couldn't take over for them, but there would be certain certainly a loss of revenue if that owner wasn't able to come in and do what they do on a day-to-day basis. And then finally, shareholders. Shareholders obviously have a critical stake in the business direction of where things are going, but they're also generally a key member of how the operations are running. I'm going to talk a little bit in the next couple slides about shareholders agreements. What I want you to recognize, though, is if you are a single owner, if you're the single shareholder or sole proprietor, I'm going to be referencing shareholders agreements, but it doesn't necessarily mean that you shouldn't be thinking through the what-if scenarios for your own business. I'm using the shareholders agreement in the next couple slides as an example of how they can be useful, how they should be used. But the what-if scenarios are even more relevant to you as an owner or you as a sole proprietor, because literally you are the one-person shop. If something happens to you, your business may not survive the next month. So some common questions that we ask is, if a key person or an owner was to be disabled or suddenly pass away, what would happen to the staff? You know, generally we've gotten into business because we're passionate about what we do. We enjoy the challenges. And when we start taking on staff, we feel an ownership and responsibility, not just for our own paycheck, but also to provide for their families. So if you were to become disabled and unable to work for an extended period of time, what would happen to your staff? What would happen if a shareholder was unable to continue to work for an extended period of time? They were disabled, diagnosed with cancer potentially, and unable to contribute to the bottom line like they previously had been. Maybe they were key in training employees, and any new hire would be trained by this person, the shareholder, to make sure that they were capable and competent to be doing their job to the standards that was expected. And then the other thing that we often never think about, because most of us get into business, we do a handshake deal, and there's not a lot of legalities behind it. But what if there was a disagreement in the future direction of a business between shareholders? It may be a disagreement between shareholders in the sense that I want to keep it private, I want to take it public. It may be a disagreement as to which way the business will go. Are we going to stay in the IT field, or are we actually going to develop out a tangible product? The other conflict that I've seen arise with some shareholders is one wants to sell off and retire from the company, the other one doesn't. And it may be hard to share 50% shares, 50% of the shares in the corporation when the new shareholder wants to have majority shares. So whether or not you have a shareholders agreement, if you are incorporated and there's multiple shareholders, you should have a shareholders agreement. And whether or not you recognize it, you've already theoretically crash test your business, because that's what a shareholders agreement is supporting. It's the what if scenarios. For those of us who aren't familiar with what a shareholders agreement is, it's quite simply a legal document put in place for the protection of each shareholder in the business. You should have a shareholders agreement if you're not the sole owner of the business, even if it is a family-run business. I can't tell you how many stories I've heard of family-run businesses where multiple generations start to get involved. The shareholders agreement was written when the company was first founded, and as more generations get added to the shareholder registry, you start to have these internal family conflicts determining how the business should be run. And unfortunately, I've seen Christmas dinners ruined because of the lack of planning that goes into shareholders agreements and the lack of review. So there's 4 key areas that shareholders agreements can speak to. And it outlines what can be done in various situations and how they're to be handled. The reason this is relevant to what the storm we're going through with COVID-19 is a shareholders agreement allows us to plan and look ahead at things that are possible to go wrong with our businesses. And we're able to do it in a situation where there's not high stress, there's not uncertainty, and there's not a sense of panic. We're able to rationally walk our way through a shareholders agreement and civilly discuss what makes sense and what is agreed to between shareholders. It's a totally different situation if you're someone who's disabled and you have shares in the corporation and you want to sell them, and the people who will most likely be willing to buy them are simply not willing to buy those shares because they don't feel that their valuation is fair. A shareholders agreement is a document that can discuss in depth how each of these situations can be handled. So it can discuss if there's a disagreement. So if there can't be an agreement on the future direction of the business, how would that be handled? It can discuss relationship breakdowns. If there's two shareholders and one of them is getting divorced, would that divorce, the person who's getting divorced, would that ex-spouse have rights to shares in that business? If there's a disability with one of the shareholders or partners, would you have the option to buy out or sell your shares in the business? And how would that be funded? And then finally, death. If there's a premature death of a shareholder in the business, how would that be funded? And there's different avenues that we're going to talk to on how that can generally be funded. Would your family be entitled to receive the shares as part of their inheritance, or would there be a deemed disposition of the equity and that the shareholders agreement would call it out? We often think that these cases are not prevalent or not frequently come across our desk or come across businesses. But what I want to do here is walk through a real life example of the impact that a shareholders agreement can have. We're going to walk through this document. It is a court document. If anyone wants a copy of it, I'd be certainly happy to send it out. It's publicly available. But basically what it is, it's a court document between Maria and B&L Nurseries. So B&L is the acronym for the company that I'm going to be using throughout my discussion about this case. Maria is the executor for her deceased husband, Fernando. Fernando, as we're going to learn about, has had 25 years employment at B&L Nurseries and is a key employee. A few things that I'm going to highlight here. The reason for the court case has nothing to do with the shareholders agreement per se. Maria's taking the company to court because of her $2.9 million settlement. She had to pay $250,000 of taxes, which her lawyer said should have been moved out through the corporate dividend account as tax-free. We're not going to get into those nuances. Just recognize that there's obviously a heightened sense of stress and emotion on both parties here. Maria just lost her husband, so she's taking the company to court. B&L, Sandra, and Peter, as we're going to find out, we're really close friends with Fernando, who passed away. And obviously, with the loss of a close family friend, not only from a business perspective, but also from a personal standpoint, are feeling that emotional loss. So Fernando worked for B&L for 25 years, and unfortunately, he passed away from cancer at the age of 46. He was married to Maria, and she was in charge of closing up or being the trustee of Fernando's estate. As part of the compensation package for Fernando, he was given shares in B&L in 2002, and he did enter into a shareholders agreement. He wasn't the only one involved in the shareholders agreement. Obviously, Peter and Sandra, the owners of B&L Nursery, were involved, but also a few others that we have listed there. All these employees, along with Peter and Sandra, were identified as key employees to B&L, so they were critical to the success of B&L. I don't know what role each of them played. The court document didn't go into those specifics. But it's also interesting to note here that they had Ken Young on staff as a chartered accountant, and his function was as the controller of B&L. Fernando was really close family friends with Peter and the employees at B&L. And even though Fernando's health declined at the later part of 2003 and he was unable to work, B&L continued to pay his wages. I do understand that the slide here is showing that Peter's health declined. It was in fact Fernando's. It's a typo in the document. So Fernando's sick. He's unable to come to work. B&L continues to pay him. So again, something else that just goes to show how integral Fernando was to the success of B&L company um, and the business. B&L did have a shareholder agreement that was put in place, and it gave very clear instructions as to the timelines that any existing shareholders could buy the shares of a deceased shareholder. So basically, it gave the other shareholders 150 days to choose whether or not they wanted to buy Fernando's shares. As we can see here, the court document clearly laid out that it was $1.5 million of equity that Fernando's shares were worth at the time of his passing. The shareholders agreement also goes into detail that after 180 days from the date of death, there's 150 days for shareholders to buy existing shares from a deceased shareholder. Then there's an additional 30 days after that, at which time B&L, the corporation, had to buy any outstanding shares. It gave very clear instructions as to how the payout structure was to happen. So it said the shares had to be paid out 25% on closing, and then the balance in 5 equal installments plus interest of the unpaid amount at 7%. Before I go on to the next section, I just want to walk through this. B&L has had a very unexpected event of the passing of Fernando. He was clearly a key member of the employment staff and the ownership and operation of B&L. He had high equity stakes in the business. And although he entered into the shareholders agreement, it's not even him that's having to work through it. It's his wife who he's left behind. She's obviously emotionally distraught with the unexpected passing of her husband. B&L is in an emotionally fragile state, both Peter and Sandra, from the loss of their friend, but also from a business standpoint. They're trying to keep the business going, and now they've been hit with this lawsuit. It's really clean and simple. It's really well laid out, in my opinion, as to how the shareholders agreement has discussed, how the shares are to be purchased, the timelines in which they're to be purchased, how the equity distributions are to happen, and any unpaid interest. It made it very clean and simple for them to implement and execute on that, and gave very little court reasoning as to Sandra's arguments as to how it should be paid out. So imagine walking through this in your own business. Maybe you're having a coworker over for dinner for Christmas because they're that close. What would happen in your own business if this was your scenario? Fernando also left all of his bonuses inside the company, and he was shown to be entitled to them by way of a shareholder's loan. So when all is said and done, Maria, at the date of passing, is entitled to $2.9 million of equity out of B&L. B&L came up with the structure as laid out in the shareholders agreement of 25% upfront and then 5 installments at 7% interest on each of the following installments. It was very clearly laid out and understood as to how it would be paid. The shareholders agreement also goes into how it's going to be funded. It goes into saying that B&L could have insurance policies on shareholders' lives at any given time, and it did in fact have an insurance policy on Fernando's life. It was for the amount of $1 million. At the time of Fernando's passing, they applied to the insurance company to receive the proceeds of the insurance policy, and they did in fact receive $1 million of life insurance proceeds. But as we can imagine, we're doing simple math here, $2.9 million minus $1 million still means B&L has to come up with another $1.9 million out of pocket. In conclusion, the court document basically outlined that in addition to losing Fernando's services, and as a result of that, suffered a significant financial blow as a result of Fernando's death, it did have to pay out to the shareholders and the loan, sorry, it did have to pay out the requirement for the share in the shareholders loan of $2.9 million. It covered $1 million of this through the insurance proceeds, and the balance of it of $1.9 million out of general revenue. So, I mean, I don't have an in-depth knowledge of B&L's working. I don't have an in-depth knowledge of the share equity for Peter and Sandra, the majority shareholders and owners of the corporation. But my hope would be that after doing this, someone's going through the shareholders agreement and saying, what kind of capital is needed if Sandra or Peter or any other shareholder happen to pass away? And do we have the funding mechanisms in place to be able to provide that kind of capital if needed? Because $1.9 million out of general revenue is pretty significant, even for a large operation. So what I want to highlight here is the shareholders agreement was written by a lawyer. They had Ken Young, an accountant, on staff, but no one stepped through and started to poke holes in what if. What happens if someone became disabled? You know, we're going to talk on the next slide, but there could have been something put in place. So instead of paying Fernando through general revenues for his disability, that they had a disability insurance policy on him. So those revenues could have gone to training a new hire, or having someone step into Fernando's role and using that extra income to subsidize that loss. And that's really where I come in with my clients, and I work with them in their shareholders agreements and their financial plan as a CFP to poke holes. It's not uncommon that I talk to professionals and corporations and I ask, you know, do you have a shareholders agreement? And the common answer I get is, absolutely we do. It's over there. What's in it? Well, I don't know. The lawyer wrote it up when we did our incorporation documents. A shareholders agreement is only valid and only makes sense when you've reviewed it and it truly fits the changes in your business. And that's something that, you know, I bring to the table when I work with clients, is poking the what if holes in the shareholders agreement, making sure, even if you don't want to plug those holes, that you're at least aware that there's holes that exist. There's different ways that people can fund shareholders agreements. The first one is what we call a sinking fund, and it's literally just that. We take cash from revenue, put it on the sideline into a safe haven, and it's just a savings account that builds up. The idea behind it is that we need the money when we need the money, and we can't take market risk with it. The downside to this is, if we look at the B&L scenario, can you imagine having just $2.9 million set aside, sitting there earning simple interest just in case? It seems to me to be a significant waste of cash flow that could be used elsewhere. Borrowing money. Borrowing money works great if you're healthy and able to work. But if you're a single owner, if you're the owner operator, if you're a sole proprietor, and you're disabled and unable to work for an extended period of time, it might be very difficult for you to obtain the loan. And it may be even more difficult in B&L's case to obtain the loan for the amount that's needed. And the cost of that lending may be prohibitive. The final scenario that we come to is insurance. You can have an insurance policy on each shareholder for the estimated amount of their shares in the event of a death or the need to buy out shares because of a disability. Premiums for the policies are deemed to be business expenses, and the capital is needed, available when the capital is needed. When Fernando passed away, B&L applied to the insurance company. The insurance company paid out the $1 million when it was needed. So a few solutions that exist that you should be aware of is what we call overhead protection. If you're a key person and you become injured or ill, this type of insurance does not reimburse you on a personal level. The idea behind overhead protection is to reimburse the company the loss of income that that person would have generated to cover business expenses. It may include things like employee salary, benefits, rent, utilities, furniture, and equipment costs. A great example of this might be if you're a dentist. and maybe perhaps you were out on the weekend and you were snowboarding, and you destroyed your shoulder, and so you were unable to do what you normally do with your arms and see patients. You have hygienists there that continue to work and bring in income, but not significant to the amount that needs to be brought in to replace the loss of your income. So you're worried about the benefits for the employees, you're worried about how you're going to continue to pay the employees, let alone the rent and the utilities. This type of insurance policy would reimburse you the loss of income so that you can cover those expenses. The premiums are tax deductible as a normal business expense. The benefits that are paid are taxable, but the expenses that the income is being used to pay are tax deductible, so it offsets itself. The next thing that I want to walk through is the health insurance side of things, the life insurance, disability, and critical illness. And I think, I'm going to say it's safe to say that we all understand that life insurance is pretty straightforward. We can get into the nuances, term versus permanent, but basically you have to die before there's a proceed. So clearly BNL used this structure in some capacity to fund the life insurance needs that were needed. It would have been really nice though for BNL to have reviewed that document with a certified financial planner, had some holes poked into it and say, I understand that you have $1 million of insurance on Fernando here. Based on today's current market valuation of the business though, the shares are actually worth $1.5 million. And so you could choose to fund that $500,000 gap or take that risk. But having those conversations and saying, not only we agree to buy the shares, but how that share purchase is going to happen is really critical. I've walked through a shareholders agreement with a contractor, and it's a three-way. The shares are split between three people, two different contractor like laborers, and then a designer. And what's unique is they've structured it such that the shares go into the corporation, which is nice and clean and simple, and then each shareholder has the ability to buy the shares. The downside, though, is there's no plan in place on how we're going to fund those. There's nothing that says we're going to take out an insurance policy, or this is the insurance policy that's funding this obligation of the business. Something to think about. It might be clearly written out that this is how we do it, or this is how the shares or the equity is brought out of the business, but it's not clear on how we're going to fund those. Disability. I spoke about this. If BNL had a disability policy on Fernando, they could have used the revenue that they were paying Fernando's income to hire somebody new, maybe train them up, and use that cash flow in a different capacity. And certainly critical illness. Critical illness, for those of us who aren't familiar with it, pays a one-time tax-free lump sum payout if you become diagnosed with a critical illness such as cancer, heart attack, stroke. Fernando might have been able to use this to help offset some of his loss of income, help provide for Maria, and so on. So as we wrap up here, some things that I really want us all to consider is we're still going through the COVID-19 storm, and it was something that was unexpected, and it created a sense of stress for some of us, some uncertainty, and maybe even some panic. And as such, as we've ridden through this storm in our own different vessels, we've all had different experiences, but I think we can all agree that our emotions might be a little higher. When we have unexpected events, emotions run higher. And the purpose of this presentation is really for you to at least try to take a step back from the operation and how to move forward with the business and say, what risks am I assuming internally? And do I have something in place that if a key employee was disabled or suddenly passed away, that I have a plan in place to address that? Or if a key shareholder suddenly passed away and I had to buy the shares from that person, there's a funding mechanism in place to be able to do that. Why not have those plans in place now when emotion and stress is not a compounding factor? A shareholders agreement is one of the first steps to take to protect your business, whether you're a startup or an established business. It does provide clarity and direction of action. So if the unexpected does happen, at least there's a starting point on how you address that situation. And then finally, I really want to encourage you to read through your shareholders agreement with your team of professionals. Not just the lawyer drafting it, but also ask the question, how do we have adequate funding in place to implement what's being written here? Is there tax efficiencies that can be written into the shareholders agreements? And we didn't get into it, but that was the primary reason why Maria took B&L to court, was to argue that the shareholders agreement should have had tax efficiencies written into it that weren't written into it. The outcome of the court case, just in case you're interested in it, was basically the judge sided with the corporation, that the shareholders agreement didn't have to put the insurance proceeds through the corporate dividend account, and the court couldn't mandate that that be done. My role as a CFP when I work with clients is not to replace your own advisors. Our goal is to work in conjunction and collaboration with your accountants and your lawyers, and to work so that you have a truly comprehensive financial plan, both on the business side where we're focusing today, but also on the personal side. Our team at Advanced Financial Planning works alongside me, works alongside your accountants and lawyers to make sure that if you have a shareholders agreement in this scenario, that you are adequately funding it, that it's written appropriately for your goals and your concerns that you're addressing. If you're a sole proprietor at the event today, if you're a sole owner and maybe there's no need for a shareholders agreement for you, maybe you don't need that document, but certainly you'd want to have in place kind of a contingency plan. What happens if I can't show up to work tomorrow? Who's going to be responsible for the day-to-day operations? How is that cash flow that I am used to generating with my own two hands and own 2 feet? How is that going to be replenished until I can get back to work? So some closing thoughts. Do you have a contingency plan, whether it be a specific shareholder agreement or something that's maybe not as formal, but do you have something in place so that if you or a key staff member becomes disabled, passes away suddenly, or even if there's a disagreement, because we're all human and we all have disagreements from time to time, how that's going to be addressed? If you do have an agreement, if you do have something in writing, when was the last time you actually read through it? Has something changed in the business structure? Hopefully your share value has gone up, and so the equity needed to buy out shares is that much more. But maybe you've overfunded or underfunded the strategy in which you're going to use, whether it be a sinking fund, borrowing, or the insurance strategy to generate that equity to do that share purchase. And do you have a plan on how you're going to fulfill the obligations of the agreement? It's great to have an agreement in place, but with the absence of the funding or how you plan on fulfilling those obligations, it's a plan. And again, it just adds, and although it creates a starting point, it doesn't alleviate the stress, the panic, and the uncertainty as to how you're going to fund that requirement if it comes through, if it's needed rather. So with that, I want to thank everyone for attending today. Hopefully you took something out of this. We've all been going through this COVID-19 storm together. We're riding in different boats, some of us in the canoe, some of us in the battleship. But regardless of what ship we're riding on, I really want to thank you for taking this time and I encourage you to step back, look at your business, who's critical to its success, and what would happen if they became disabled for an extended period of time, they suddenly took ill and were unable to come to work. If you yourself or they happen to pass away prematurely, what would happen not only to the business, but to their families, to your customers, and the business that you've worked so hard to develop? So with that, I'll pass it back over to Alana.